live in a globalized economy, and China's $7 trillion real estate empire is now crumbling, while Europe is facing an energy crisis, while other countries around the world are facing a food shortage. China is the largest trading partner with the United States, and they're the second largest holder of United States debt, second only to Japan. And in 2020, the Chinese government and economy purchased $310 billion worth of stuff from the United States, and the United States bought $430 billion worth of stuff and goods from the Chinese. The benefits of a globalized economy is you can rely on other countries to make stuff for you, sometimes much cheaper than you can. Like the United States can get stuff made from China significantly cheaper than we can make it here. If you want to make a t-shirt in China, well, you can pay people a whole lot less. It's cheaper to open up a factory, so it's cheaper to produce products in China than here, which allows you to buy stuff cheaper in the United States, but it also has its own downfalls. The downfalls of globalization is now you're relying on other countries, because now if the Chinese economy starts to hurt, that can hurt the United States economy. And if the Chinese economy wants to create some sort of economic warfare with our country, well, that can hurt us because we're so reliant on them. So there's pros and cons to this type of globalization, but what I want to focus on are the financial issues now, because we're seeing countries like China start to struggle. And we're seeing Europe as a whole really struggle with inflation and really struggle with this energy crisis. So these things will have an impact on the United States as we live in this globalized world. And there's three areas that I want to focus on, especially when it comes to this Chinese economic slowdown. The number one is buyers for our stuff and how the Chinese economic slowdown affects trade between China and the United States. Second, I want to talk about how it affects our national debt and our government spending, because like I said before, the Chinese government and the Chinese are the second largest holders of United States treasuries, meaning the United States debt are dollars. And third, how it affects inflation here in the United States, because the Chinese economic slowdown would affect our inflation. This one is the most obvious, so I'm going to go through this one the most quickly, because now Chinese and the United States are very large trade partners, like I just showed you before. What do the Chinese buy from the United States? Well, they buy things like planes and cars and food. And so if their economy is hurting and they're not producing as much money, they're not producing as much profits, then they're going to have less money to buy stuff from us. That means that our companies here in the United States hurt because they have less people to sell things to, because again, China is the largest trading partner with the United States. Think of it this way. You have a company that sells guacamole, and your biggest customer, your number one biggest client that purchases your guacamole now starts to suffer, so they buy less guacamole from you. So this is the first issue that you want to be aware of, is that as the Chinese economy slows, they're going to be buying less stuff from the United States. Second, when the Chinese government slows down, not only does China have less ability to buy stuff from the United States, but they also have less ability to buy government debt from the United States. So when the United States government spends money it doesn't have, it has to get this money from somewhere. Either they're going to print this money from the Federal Reserve Bank, or they're going to borrow this money from somewhere. Where did they borrow this money? Well, they borrow this money from other countries. The number one biggest lender to the United States is Japan. The number two biggest lender to the United States is China. So if China's economy is struggling, they're going to have less ability to buy debt from the United States, aka they're going to have less money to loan to the United States. This then will affect things like your mortgage rates and our interest rates when it comes to bonds. My team broke this story down in Market Briefs, which is my free financial newsletter. But now if China is one of the biggest buyers of the United States debt, but they don't have the ability to keep buying United States debt, that means that there's going to be less demand for United States debt. These are called United States Treasury bonds. So now if there's less demand for these treasury bonds, the United States government is going to have to pay a higher interest rate in order to attract more buyers to buy the treasury bonds. Because now the way the treasury bonds work is when you have less demand, less people want to invest in treasury bonds, that means that it might be riskier. And so to compensate for this risk, to attract more buyers, they have to raise interest rates. So that means now when the government has all this national debt, they have to pay higher interest rates on this national debt. And the second part to that is that now when banks go out and issue a mortgage, many times they will base their mortgage rate based off of what the 10-year treasury note is. AKA, they look at how much money or how much interest the government is charging on their 10-year treasury bonds, and then they're going to base their mortgage rates based off of that. So if the government has to now pay out higher interest rates because there's less buyers for government debt, that means that now the government has to pay more money in interest to finance and borrow money. If they have to pay more interest to borrow money, that means that more of your tax dollars are being used to pay off your previous government debts. The United States government already has $30-some trillion worth of national debt, and so if the interest rates go up, that means the interest rates on future debts is going to be more expensive, so the government had to spend more of their tax dollars to pay off more of their previous purchases. And then that means when you want to go in and get a mortgage, or if you want to go in and get a loan, now it's going to be more expensive for you because interest rates are higher as well. Now, of course, this isn't the only aspect that influences interest rates, because the Federal Reserve Bank can also set interest rates, but these are all different factors that play onto one another. And if there are less buyers for United States national debt, that is one of the factors that push interest rates higher. This brings me to the third point that you want to pay attention to, which is inflation. But if you do want to stay up to date on what's happening in the top finance and business news like this is where you have to join Market Briefs, which is my free financial newsletter where every day my team is breaking down what's happening from the stock market to the real estate market to the crypto market to inflation to the global economy to stories like this. It is completely free, and my team will break down what's happening into a fun, easy to read and witty email that I promise you're going to look forward to reading every single day. So if you haven't joined Market Briefs yet, I'll put the link to how you can join for free down in the description below. Right now, we've been seeing the effects of having a very strong dollar, because if you look at the dollar relative to other countries and currencies around the world, the dollar has been gaining in a lot of strength. That's why you're seeing the dollar being compared to the euro and the pound and the yen, and it shows you that relative to many other currencies, the dollar has been growing in strength. But if there is less demand for United States government debt, it means there's also less demand for the United States dollar. If there's less demand for the United States dollar, that weakens the United States dollar. If the United States dollar is weakening more, that is a trigger for higher inflation. Now, there is some good news when you have a weaker dollar. This is one of the reasons why President Donald Trump, when he was in office, was openly pushing for a weaker dollar, because when you have a weaker dollar, it now makes it cheaper for other countries to buy stuff from the United States. Because when you have an expensive dollar or a very valuable dollar, well, that makes stuff from the United States more expensive, more valuable. And so for another country, like say China, to buy stuff from the United States, it's more expensive for them. But when you have a weaker dollar, it makes it cheaper for other countries to buy stuff from the United States. Now, there's also consequences to this, because now when you have a weaker dollar here in the United States, that means that now when you buy commodities, something like, say, oil, which is based on the value of the dollar, and you have a weaker dollar, that makes oil more expensive. So you have to pay more money for gas. So when you have a weaker dollar, it hurts consumers more, because now you have to pay more money for your things like gas, and it means higher inflation. So in general, as a regular consumer, a stronger dollar is better, because that means that your gas will typically be cheaper. And if you were to travel anywhere around the world, you can buy more stuff with the $100 that you have, versus when you have a weaker dollar, that means that now your gas is more expensive. And if you were to travel around the world, now you need more money to buy things anywhere else in the world. This is why it's so important to be paying attention to what's happening in the financial markets, not just here in the United States, but also around the world, because we live in a globalized economy, and all these different things happening, especially with the major economic players like the EU and China. As they're starting to slow down, as they're starting to struggle, you want to pay attention to what's happening there, because that will have a direct impact on what's happening here in the United States. Now, of course, we'll be keeping you up to date on Market Briefs, and I'll do my best to keep you updated here on my channel as well. Remember, your income minus your expenses equal your investments plus your savings. And so now you're working to lower your expenses, so you have more money going to your investments and your savings. But now what you're saying is, I want to put more money towards my investments and my savings, because you start to fall in love with this whole idea of financial education. You start to fall in